Start with the simple shift nobody announced out loud, from healthcare to life asset management. When investors look at the end of life, they don't see just patients and families. They see a pipeline. Seniors housing on the front end, hospice at the exit ramp, funeral and cremation as the final toll, and for some, a last stop with medical debt buyers. Every gate in that line has price power. Put them together and you have an asset with non-discretionary demand. Here's how the math reads inside an investment memo. First, length of stay. In hospice, the per diem rate is predictable. If you can steer referrals earlier and discharge patients who need higher cost intensive care, average margins rise. In seniors housing, longer occupancy and regular rent escalators drive yield. In funerals, adding services at the moment of maximum stress lifts the ticket size. The common thread is control of time and choice. If you can predict when people enter, how long they stay, and what options they're shown, you can model cash flows like a utility. Then look at who's assembling the pieces. UnitedHealth's Optum unit has been buying the middle and the exit. It closed a $5.4 billion acquisition of LHC Group, and then moved on Amedisys in a $3.3 billion deal announced, and completed across 2024 to 2025. That's home health plus hospice at national scale, plugged into clinics and a pharmacy benefit manager. The strategy isn't mysterious. Capture the end-of-life spend by owning the referral funnels, the nurses, and the billing rails. Private equity saw the same map. Hospice has been one of their favorite roll-ups because it's fragmented, reimbursed by Medicare, and sensitive to length of stay and staffing mix. Owners can consolidate back offices, trim visit intensity, substitute lower-cost labor, and push for earlier admissions through hospital and primary care relationships. The problem for families is that these efficiencies show up where it hurts. In 2024, researchers from Emory University, Vanderbilt University, and while Cornell reported that hospices owned by private equity or publicly traded companies earned the lowest performance ratings and worst caregiver experiences across key measures. That's not a slogan. That's caregivers saying the care felt worse. Now connect pricing power to the rest of the pipeline. Senior living real estate investment trust structure leases with automatic rent escalators and tack on ancillary fees for care coordination, therapy, and transportation. Funeral chains quietly buy local homes and centralize cremation capacity, then raise list prices in markets with fewer competitors. When a loved one dies, families often only see one or two nearby options, both owned by the same parent. Add grief, time pressure, and opaque price sheets, and the upsell writes itself. What makes this a thesis instead of a list of deals is the yield profile. End-of-life spending doesn't slump when the economy does. Mortality has a curve. That curve is aging upward as the large mid-20th century birth cohorts move through their 70s and 80s. And the wealth is sitting right where the pipeline meets the customer. Americans 55 and older control more than $124 trillion in household wealth. To an investor, that looks like a toll road running through the richest neighborhood in the country, with traffic guaranteed. There's another lever, prediction. The more precisely owners can forecast who will enter care and when, the more tightly they can manage labor, inventory, and billing. Insurers and risk managers have upgraded mortality tables with machine learning. Academic teams, including work out of Stanford, built models that predict one-year mortality with high discrimination. Those tools don't just live in journals. They migrate into underwriting, claims management, and referral targeting. A small shift in predicted risk can reprice a book of business by billions. It also nudges which patient gets what visit, which plan requires prior authorization, and where a referral lands. Inside a private equity model, that prediction ties back to control. If you own the clinic, the home health agency, the hospice, and the pharmacy benefits, you can nudge the route. A diagnosis code here raises risk scores and captures more reimbursement. A formulary tweak there pushes a cheaper drug first. A prior authorization delay buys time while a quarter closes. None of this is a movie villain. It's a series of toggles run by people who are paid to hit targets. For families, it shows up as premiums drifting higher, surprise bills for observation status, and cremation costs that climbed faster than inflation. For nurses, it shows up as shorter visits, more patients per shift, and burnout. For small-town funeral directors, it shows up as a friendly buyer who later standardizes prices. The through line is that time, how much you have and how much you use, becomes a line item. Here's the irony most of us don't see until it's too late. The capital funding this pipeline often comes from pensions and insurers tasked with protecting retirees. Low interest rates in the 2010s and early 2020s pushed those institutions to hunt for steady, uncorrelated returns. End-of-life services promised exactly that. So the same money meant to make retirement safer helped build the machine that bills retirees and their children. It's a closed loop by design. To understand why almost every lever points the same way, we need to go back to the moment investors ran out of easy yield and started pricing certainty wherever they could find it. The yield famine that set all of this in motion. The yield famine that started it. Three things collided after the financial crisis and wouldn't let go. Rates fell and stayed low, obligations to retirees kept rising, and markets got choppy. Pension funds, insurers, and endowments needed dependable spread, not hero bets. Bonds didn't pay enough, equities swung too much, and hedge funds weren't matching actuarial math. So the mandate shifted. Find assets with cash flows you can map years out, with customers who can't opt out. That's when end of life moved from a line item to a target. Liability matching sounds dull until you see how it moves billions. A corporate pension promises checks for as long as workers live. The risk is longevity. People live longer than the spreadsheet assumes. If you can price that risk with precision and pass it to someone who wants it, you lock in predictability. That's the logic behind pension risk transfers. Employers push their pension blocks to an insurer. The insurer then reinsures that longevity exposure, often with affiliates designed for capital efficiency. By 2024 and 2025, more of that reinsurance capacity sat in platforms linked to private equity, frequently domiciled in places like Bermuda that offer lower capital charges. What sounds like a shuffle is a funnel. Retiree lifespans turn into assets managed for yield. The chase didn't stop there. Investors went hunting for cash flows that resist recessions. They call them non-discretionary. You don't decide whether a parent needs help bathing or whether a body needs cremation. You don't bargain for a hospital discharge. If you can acquire the operators who bill for those moments, and you can raise prices a few percent each year, your models smooth out. That was the pitch, resilient demand with operational levers. This wasn't the first time finance turned human rhythms into securities. The pattern echoes. In the 1980s, mortgages became bonds. In the 2000s, buyouts turned companies into collateral for debt. In the 2020s, the search moved inside the body. Call it biocash, cash flows tied to diagnosis codes, admission windows, and actuarial tables. Each era learned the same lesson. When the model works, you look prescient. When it misses, you discover how quickly small errors compound. Demographics made the spreadsheets glow. The cohorts born in the 1940s through the 1960s were marching into their 70s and 80s, where healthcare spend accelerates and mortality curves steepen. That wave is measurable. It's not a guess, it's a timetable. Layer on wealth concentration, and the attraction becomes obvious. Americans aged 55 and older now hold north of $124 trillion in household wealth. That's home equity, retirement accounts, brokerage assets. The savings of a generation that benefited from rising markets and housing booms. If you place tolls across the services they must cross in their final decades, aggregate returns look dependable. The playbook that followed was familiar. Roll up fragmented providers to gain negotiating power and back-office scale. Add leverage to juice equity returns. Raise prices where customers are in distress or face few alternatives. Cut costs by adjusting staffing ratios and replacing higher-paid clinicians with cheaper labor where rules allow. Then sell the platform to the next buyer, or take it public as a real estate or operating company that spins steady dividends. On paper, it's efficient. At the bedside, it's thinner. Once investors saw the math, they moved on the gatekeepers, the places where a referral starts, where a diagnosis gets coded, where a discharge gets routed. Control the funnel, and you. Shape length of stay and mix of services. That's why home health and hospice chains attracted strategic buyers like Optum, and why private equity targeted regional operators with hospital ties. Owning the rails means owning the rhythm, who gets admitted when, and how long they stay. Parallel to that consolidation, the risk markets started refining their tools. Longevity swaps and reinsurance treaties turned population life expectancy into tradable exposures. The more accurate the mortality curves, the tighter the pricing, and the more confident the capital. Advances in machine learning made those curves sharper. Academic projects, including Stanford-linked work, demonstrated high discrimination for one-year mortality using clinical and claims data. Those algorithms didn't stay in labs. They informed underwriting, reserve setting, and the valuation of whole blocks of policies and pensions. A fractional change in assumed mortality. People living 2 months longer on average, say, can swing valuation by billions across large books. Rate regimes nudged everything along. When safe bonds yielded little, the premium for certainty rose. End-of-life services, structured as leases, per diems, and fee schedules, looked like mini-infrastructure assets. Senior living REITs offered rent escalators and ancillary fees. Hospice per diems offered steady reimbursements. Funeral pricing could step up as local competition thinned. Package those features, lever them, and suddenly you've built a synthetic bond paying far more than treasuries with customers who show up regardless of GDP prints. But there's a twist that keeps getting missed. The ultimate payers, the retirees and their families, are also the capital providers. Pension funds and insurers invest into private equity funds and credit vehicles that acquire the operators who later bill those same households. Premium dollars and retirement contributions flow upstream, then return downstream as invoices and rent. It's efficient capital recycling from a spreadsheet's view. From a kitchen table, it feels like paying twice. By the late 2010s and into the mid-2020s, the famine for yield had trained an entire ecosystem to see years and diagnoses as pricing variables. The conclusion wasn't whispered, it was published in pitch decks. If you can predict and manage the last miles of life, you can deliver stable returns across cycles. And once prediction improved, the temptation to steer followed. That's the hinge. Forecasting risk is one thing. Owning the levers that change it is another. Consolidating the gateways of death. While the models sharpened in the background, the buying spree moved to the foreground. The first gates were the ones families see. The funeral home on Main Street, the hospice that sends a nurse to the living room, the senior residence with the cheerful brochure. Each looked local. Many weren't. Funeral chains learned the oldest trick in retail: control capacity and blur the brand. They bought independent homes, kept the legacy names, and centralized embalming and cremation at regional hubs. With the ovens and staff consolidated, they could ration slots and inch up prices without a public fight. Families tended to shop once, under deadline, without a clear price list. In many counties, the two different options on Google shared the same parent company. That's how list prices rose, add-ons multiplied, and the final bill crept from painful to punishing. When households asked why the cremation fee jumped again, the answer was a sympathetic shrug and a laminated price sheet. Hospice consolidation followed a similar pattern, but with a Medicare twist. Reimbursement comes as a per diem, paid for each day a patient is enrolled. That makes length of stay a profit lever and staffing a cost center. Private equity buyers stitched together regional agencies, standardized back-office systems, and then tuned the dials that drive margin, visit frequency, clinician mix, and discharge patterns. Meanwhile, strategic buyers went for scale with a different aim. UnitedHealth's Optum didn't just want a hospice, it wanted the funnel. It closed the $5.4 billion LHC Group deal, and then completed a $3.3 billion acquisition of Amedisys across 2024 to 2025. That put home health and hospice under the same roof as clinics, claims analytics, and a pharmacy benefit manager. Owning the rails means you can route the train. Families felt the shift in small, accumulating frictions. A nurse who once stayed an hour now stayed 40 minutes. A weekend call rolled to a national desk that promised a callback. The hospice chaplain who knew local clergy was replaced by a rotating contractor. Care didn't vanish, it thinned. In 2024, researchers connected the dots. Teams from Emory University, Vanderbilt University, and while Cornell reported that hospices owned by private equity or publicly traded companies posted the lowest performance ratings and worst caregiver-reported experiences across key COPS measures. That's not ideology. That's families saying the experience slipped. Senior living real estate added another gate with a lock. Many operators don't own the buildings. They lease them from real estate investment trusts. Those leases often include automatic rent escalators, inflation riders, and requirements to maintain occupancy. When costs rise, fees rise. Ancillary charges, medication management, transportation, personal care become revenue lines. In a tight market, residents have few alternatives nearby. When an operator changes hands, the lease terms don't soften, they harden. A daughter trying to keep her mother in the same apartment now faces a letter announcing a 5% bump plus a care coordination fee. The choice is simple and brutal. Pay or move her mother away from friends and familiar hallways. Behind the scenes, lab and pharmacy integrations tighten capture. If the same parent controls the home health agency and the specialty pharmacy, more of each patient dollar stays inside the house. Formularies can nudge cheaper drugs first. Delivered oxygen can be billed through affiliates. Billing teams learn every reimbursement nuance, maximizing allowable codes while minimizing service intensity that doesn't move the needle. It's legal. It's also how a spreadsheet tells a bedside what to do. The market structure finished the job. In many regions, roll-ups created quiet monopolies or duopolies. Funeral homes with common ownership set the local floor on cremation. Hospices linked to hospital referral systems won most admissions. Senior residences bound by REIT leases marched prices in step. Families didn't see a monopoly flag. They saw a cluster of familiar logos that, in practice, led to one balance sheet. With fewer independent options, negotiation became ceremony. Here's the part investors rarely say out loud. Consolidation doesn't just raise prices. It narrows choices at the exact moment when choice is everything. End of life is personal, cultural, and spiritual. It needs slack, time to ask questions, space to change course, people who know the terrain. Regional scale flattens that texture. You get call centers, templated care plans, and quarterly targets that roll downhill. Meanwhile, the prediction engines kept feeding the front end. If you can forecast who's likely to need home health in 60 days, you can have the referral relationship in place. If you own the clinic and the hospice, you can steer within the rules. The machine learns, the network routes, and the margins print. Pricing power is one pillar. Prediction is the other. The two together turn the last miles of life into a managed yield. The prediction engine, pricing your lifespan. While consolidation tightened the gates, the real shift happened in the spreadsheets that guessed the future. Insurers and operators stopped relying on blunt actuarial tables and started using models that learn. Claims histories, diagnosis codes, prescription fills, lab results, even gaps in refills. Each becomes a signal. Academic teams, including work out of Stanford, showed you could predict one-year mortality with high discrimination using routine clinical data. That wasn't trivia. It was a map for money. Here's how it moves from paper to pocket. A model flags two patients with the same diagnosis. One has irregular pharmacy fills, a recent ER visit, and lives alone. The other has steady refills and regular primary care. The algorithm assigns different one-year death risks. In underwriting, that can mean different premiums or stricter terms. In Medicare Advantage, it can steer coding intensity and drive higher risk-adjusted payments. In a hospice funnel, it can nudge who gets a call first and how early. Policy lapses, people stopping premium payments, used to look like noise. Now, lapse models predict who's likely to quit based on credit signals, job changes, and adherence patterns. If an insurer expects you to lapse, it prices or markets differently. If it expects you to live longer than average, it trims margins or reinsures the tail. Wearables and wellness apps add another layer. Steps, sleep, heart rate, glucose. Data that once lived on your phone now inform a risk portrait. Even if a carrier swears it isn't underwriting with that feed, it can still segment marketing, design incentives, and quietly tilt future pricing. Medicare Advantage supercharged the game. Plans get paid more for sicker members, so documentation intensity matters. That's where diagnostic upcoding debates live. If predictive tools suggest a member's true risk is higher than records show, there's pressure to complete the profile. Each extra code unlocks higher payments. From a clinician's perspective, it's documentation. From a finance perspective, it's revenue capture. Meanwhile, prior authorization systems absorb prediction, flagging which requests are likely low value and can wait, and which denials will probably be overturned on appeal. Delay becomes a tactic. Now follow the risk to the balance sheet. Pension risk transfers move corporate pension promises to insurers, who then move longevity exposure to reinsurance affiliates, many linked to private equity and domiciled in capital-light jurisdictions like Bermuda. That's where the mortality models bite hardest. If an algorithm shifts the expected survival of a pension block by weeks, the present value of the liability moves by millions, across many blocks by billions. Longevity swaps let counterparties trade exposure to people living longer than expected. The same math that helps a hospice forecast caseload helps a reinsurer price tail risk. Life settlements sit on the same rail. Investors buy policies from seniors and pay the premiums, betting the payout will beat the carry. Predicting time to maturity is everything. Early academic mortality models that beat standard tables gave funds an edge. As machine learning spread, that edge got thin, so funds layered medical underwriting, pharmacy data, and social variables. Again, a tiny shift in expected months can swing a fund's returns. One algorithm update, one new predictor, and a settlement portfolio can reprice overnight. Here's the problem nobody puts in the brochure. Prediction always tempts control. If a model says a patient is likely to die in 6 months, and you own the clinic, home health, and hospice, you can steer appropriate care pathways that also align with reimbursement. Early engagement sounds humane, and sometimes is, but it can double as margin optimization. Formularies lean to cheaper drugs first through step therapy. Prior authorization slows escalations to higher-cost treatments. Staffing models shave minutes off visits that the algorithm deems low impact. Every toggle can be defended. Taken together, they shape outcomes. Families feel it in ways that don't look like AI. A daughter wonders why her mother's referral skipped the community hospice down the street and landed with a chain tied to her Medicare Advantage plan. A son notices the pharmacist insisting on a cheaper alternative that leaves his father groggy. A nurse gets a dashboard reminder to close out a visit at 40 minutes. None of this requires a villain. It requires incentives and a forecast. Meanwhile, the feedback loop tightens. Claims data trains the model. The model guides care pathways. The pathways shape claims. If a plan's prior authorization rules delay care that would have extended life by weeks, the mortality curve it observes will look a bit steeper next year. That sharper curve then supports tighter pricing and new denial thresholds. It's self-fulfilling unless checked. All of this lands in one sentence. A fractional change in predicted risk moves real money. Pension blocks reprice. Reinsurance treaties reset. Settlement funds mark up or down. Hospice operators tune labor. Insurers tilt premiums. The people inside those curves don't see the math. They feel the nudges, the extra form, the shorter visit, the delayed approval. Prediction was supposed to help plan care. Where incentives in the wrong hands,